Investing money for maximum returns.
Hi. Today we have an exciting topic to discuss: investing money for maximum returns. Investing can be a powerful tool to grow your wealth over time. But before we dive into the details, make sure to hit that subscribe button, like this video, and share it with your friends who are looking to make their money work smarter, not harder. 1. The power of investing. To kick things off, let's talk about the power of investing. Imagine you have $10,000 sitting in your savings account. If you leave it there, it might earn you a tiny bit of interest, but it won't grow significantly. However, if you invest wisely, it has the potential to grow exponentially over time. Take a look at this example. Let's say you invested $10,000 in a diversified stock portfolio 30 years ago. Historical stock market data shows that, on average, the stock market has returned around 7–8% per year over the long term. So, how much do you think that initial $10,000 investment would be worth today? Well, after 30 years of compounding returns, that $10,000 would have grown to over $76,000. That's the power of investing. 2. Types of investments. Now that you understand the potential, let's dive into the different types of investments you can consider. Stocks. These represent ownership in a company, and their value can fluctuate based on the company's performance and market conditions. Bonds. Bonds are essentially loans you give to companies or governments in exchange for periodic interest payments and the return of the bond's face value when it matures. Real estate. Investing in properties, whether residential or commercial, can generate rental income and appreciate in value over time. Mutual funds. These are investment vehicles that pool money from multiple investors to buy a diversified portfolio of stocks, bonds, or other securities. Exchange-traded funds, ETFs, similar to mutual funds but traded on stock exchanges like individual stocks. Cryptocurrencies. Digital assets like Bitcoin and Ethereum have gained popularity as alternative investments. Let's explore some real-life examples to illustrate the diversity of these investments. Think about Apple Inc. If you had invested $1,000 in Apple stock in 2003, it would be worth over $100,000 today. That's the power of investing in individual stocks. On the other hand, government bonds, like U.S. Treasuries, are considered safe investments. They provide a predictable stream of income and preserve your capital. Real estate can also be a fantastic investment. Owning rental properties can generate passive income through rent payments and appreciate in value over time. If you prefer a hands-off approach, mutual funds and ETFs offer diversification. For instance, the S&P 500 ETF has historically provided solid returns by tracking the performance of 500 major U.S. companies. Cryptocurrencies, like Bitcoin, have gained attention for their incredible growth potential. Bitcoin's value has skyrocketed over the past decade, creating substantial wealth for early investors.
3. Risk and return.
In the world of investments, there's a fundamental relationship between risk and return. Generally, the higher the potential return, the higher the risk you'll have to take on. Take a look at these examples. High risk, high return. Startups and small-cap stocks can offer tremendous returns, but they come with a high level of risk. Many startups fail, and small-cap stocks can be extremely volatile. Moderate risk, moderate return. Blue-chip stocks of well-established companies tend to have more stable returns but still carry some risk due to market fluctuations. Low risk, low return. Government bonds and savings accounts are low-risk investments, but their returns are relatively modest. Let's explore a real-life case study to emphasize this point. Imagine you invest $10,000 in a promising startup. There's a chance it could become the next big thing, and your investment could grow tenfold or more. However, there's also a significant risk that the startup could fail. Now, consider investing the same $10,000 in a well-established, Fortune 500 company. While the potential return might not be as dramatic as the startup, the risk of losing your entire investment is much lower. Finally, let's say you decide to invest in government bonds. Your returns will be more predictable and stable, but they will also be relatively modest compared to the previous two options.
4. Diversification.
To manage risk and maximize returns, diversification is a key strategy. Diversification means spreading your investments across different asset classes and industries to reduce the impact of any single investment's poor performance. Let's look at some real-life examples of how diversification can work. Imagine you have a $100,000 investment portfolio, and it's diversified across stocks, bonds, and real estate. If one asset class underperforms, the others may compensate for the losses, helping you maintain a steady overall return. Now, compare that to an undiversified portfolio heavily concentrated in a single stock. If that stock tanks, your entire portfolio could take a massive hit. So, the lesson here is simple: don't put all your eggs in one basket. Diversify your investments to reduce risk and increase your chances of achieving maximum returns over the long term. 5. Investment strategies. Now that we've covered the basics, let's talk about some investment strategies that can help you maximize your returns. Long-term investing. Invest with a long-term perspective. Historically, markets have shown an upward trend over time, and staying invested for the long haul can help you ride out market fluctuations. Dollar cost averaging. Invest a fixed amount of money at regular intervals, regardless of market conditions. This strategy can help you buy more shares when prices are low and fewer shares when prices are high. Asset allocation. Determine the right mix of assets, stocks, bonds, real estate, etc., that align with your financial goals and risk tolerance. Rebalancing. Periodically review and rebalance your portfolio to maintain your desired asset allocation. This ensures that you're not overly exposed to one asset class. Tax-efficient investing. Be mindful of taxes when making investment decisions. Utilize tax-advantaged accounts like IRAs and 401ks and consider tax-efficient investment strategies. Let's see how these strategies can play out in real life. Consider a scenario where you invest $10,000 in a diversified portfolio of stocks and hold it for 20 years. Even with market ups and downs, your investment could grow significantly. Now, imagine you contribute $500 to your investment account every month, regardless of market conditions. During market downturns, your monthly contribution buys more shares, effectively lowering your average cost. Asset allocation is crucial. Let's say you're nearing retirement, and you shift your portfolio toward more conservative investments like bonds to protect your nest egg from market volatility. Finally, tax-efficient investing can make a substantial difference in your after-tax returns. Utilizing tax-advantaged accounts and strategies can help you keep more of your hard-earned money. 6. Common mistakes to avoid. Before we wrap up, let's discuss some common mistakes to avoid when investing for maximum returns. Here are a few pitfalls to watch out for. Emotional investing. Letting fear or greed drive your investment decisions can lead to buying high and selling low. Stick to your strategy and avoid impulsive moves. Chasing hot tips. Don't invest based on the latest hot tip from a friend or online forum. Do your research and make informed decisions. Neglecting diversification. Overly concentrating your investments in one area can expose you to unnecessary risk. Diversify your portfolio. Ignoring fees. High fees can eat into your returns over time. Look for low-cost investment options. Timing the market. Trying to predict market movements is a losing game. Stay invested for the long term and avoid trying to time the market. If you let emotions drive your investment decisions, you might panic during market downturns and sell at a loss, as shown in this chart. Chasing hot tips can lead to impulsive investments that don't pan out. It's essential to rely on research and a well-thought-out strategy. Neglecting diversification can result in significant losses when a particular sector or asset class underperforms. Market timing rarely works. Trying to predict when to buy or sell can lead to missed opportunities and lower overall returns. And there you have it, investing your money for maximum returns. Remember that investing is a long-term game, and there are no guarantees. By understanding the power of investing, diversifying your portfolio, and avoiding common mistakes, you can increase your chances of achieving your financial goals. Thanks for watching.